Every morning people observe the rising costs of daily necessities at their local markets and wonder about the future of their hard-earned savings. The global financial landscape currently stands at a historic crossroads as traditional economic certainties fade away completely. Investors carefully watch the markets daily as unprecedented geopolitical events reshape global capital flows. State Street Investment Management recently released a comprehensive analysis regarding the future trajectory of precious metals. The prominent institution anticipates that gold prices will continue pushing above $5,000 per ounce. This optimistic forecast persists despite several significant near-term headwinds challenging the broader global financial markets right now. Akash Doshi leads the commodity analyst team at State Street Investment Management with profound market expertise. His dedicated group emphasizes a strongly bullish stance on the long-term prospects for precious metals. They firmly believe that solid structural support levels exist beneath the current volatile market price fluctuations we see. The financial institution recently adjusted its most aggressive bullish expectations to reflect changing global economic realities. Analysts slightly reduced the probability of their most optimistic scenario occurring before the current year ends. Nevertheless, they maintain high confidence that previous historical price highs will experience another test very soon this decade. According to their updated monthly report, the base case projection remains extremely favorable for precious metals. The analysts assign a 50% probability that prices will fluctuate within a highly elevated range. This baseline assumes continued steady institutional demand, despite the presence of numerous challenging macroeconomic headwinds worldwide right now. The analysts also outline a specific bear case scenario, carrying a 20% probability of occurring. Under these difficult conditions, prices might retreat toward the $4,000 level as definitive support. Such a decline would likely follow a material resolution of ongoing global trade tensions and conflicts this year. A massive bull case scenario retains a 30% probability in the latest institutional forecasting models. This optimistic outcome suggests prices could surge toward $6,250 per ounce. Severe supply chain disruptions and escalating geopolitical conflicts would serve as the primary catalysts driving tremendous growth forward. The gold market faced intense volatility during the first quarter as unprecedented price swings rattled investors. A sudden correction pushed prices lower following a remarkable period of rapid appreciation and record highs. Experts at State Street Investment Management suggest this recent market consolidation phase is completely healthy ultimately for investors. Short-term headwinds include a significant shift in global financial market sentiment due to military conflicts. The ongoing war involving the United States and Israel against Iran created severe energy market disruptions. These unexpected geopolitical shocks fundamentally altered previous expectations regarding future monetary policy and central bank actions going forward. At the beginning of the year, markets anticipated substantial interest rate cuts from the Federal Reserve. Investors initially priced in 58 basis points of easing to support broader economic growth initiatives. The sudden turmoil in the Middle East quickly erased those optimistic monetary policy forecasts almost entirely this spring. Persistently high oil prices emerged as a primary driver of renewed inflation expectations across global markets. The energy shock rippled through various asset classes and forced traders to rapidly reconsider their positions. Consequently, money markets began pricing in higher interest rates instead of the previously anticipated policy cuts we expected. By late March, market participants actually assigned a 60% probability to an interest rate hike. This dramatic reversal in monetary policy expectations put tremendous downward pressure on non-yielding assets temporarily. Higher real yields generally increase the opportunity cost associated with holding precious metals in investment portfolios right now. The stronger United States dollar accompanied the sudden rise in real interest rates during the spring. A robust currency typically makes precious metals more expensive for international buyers utilizing foreign exchange markets. State Street Investment Management notes that this cyclical pressure caused the notable price correction during March this year. Despite these formidable challenges, gold prices demonstrated remarkable resilience by maintaining strong support above previous lows. The precious metal absorbed the selling pressure and established a new baseline floor around 4,000. This defensive strength indicates that fundamental demand remains incredibly robust despite monetary policy headwinds restricting economic growth globally. The analysts emphasize that the recent correction does not represent a breakdown of the core thesis. Global demand for precious metals stems primarily from deep concerns regarding currency depreciation and wealth preservation. Investors continue seeking alternative assets that operate entirely outside the traditional fiat currency and banking systems we trust. High energy costs act as a double-edged sword for the global economy and precious metals. Elevated crude oil prices exacerbate inflationary pressures while simultaneously threatening to stifle broader economic growth metrics. A prolonged conflict pushing oil above $150 per barrel increases recessionary risks significantly for everyone. An economic recession or period of stagflation would fundamentally alter the monetary policy landscape once again. Under those difficult conditions, central banks would face immense pressure to abandon their restrictive policy stances. Such a dovish pivot would quickly propel precious metals back above the $5,000 mark almost overnight. Alternatively, a normalization of energy markets could provide immediate relief to struggling global supply chain networks. If oil prices retreat to normal ranges, inflation expectations would moderate and stabilize across the board. This stabilization would allow the Federal Reserve to resume its planned trajectory of interest rate reductions this year. State Street Investment Management advises clients to look past the daily fluctuations of interest rate expectations. The firm encourages a strategic focus on the broader structural forces shaping the global macroeconomic environment. These powerful long-term dynamics remain overwhelmingly favorable for assets that cannot be printed or debased by governments. One primary structural catalyst is the concept of fiscal dominance taking hold in major developed economies. Fiscal dominance occurs when persistent and massive government deficits begin to dictate central bank monetary policy. Policymakers become severely constrained in their ability to raise rates without triggering a sovereign debt crisis very quickly. The unsustainable expansion of government debt worldwide constitutes a massive long-term positive factor for gold. Total global debt has skyrocketed to a staggering record level of approximately $348 trillion. This astronomical figure represents roughly 3 to 4 times the total global gross domestic product currently recorded. This explosive debt growth is heavily concentrated within the public sector rather than private enterprise borrowing. The United States national debt continues expanding at a pace that alarms international creditors and taxpayers. Analysts note that the macroeconomic backdrop of high debt historically supports increased precious metals demand significantly over time. The United States Congressional Budget Office released projections highlighting the severity of the current fiscal trajectory. Annual net interest payments on federal debt now exceed $1 trillion for the first time. This massive interest burden consumes an increasingly large portion of the overall national budget each year moving forward. Widening fiscal deficits are driven by expanding military expenditures and significantly higher debt servicing costs continuously. Reduced tax revenues further exacerbate the structural mismatch between government income and mandatory spending obligations domestically. These embedded fiscal pressures signal a prolonged period of potential currency devaluation and systemic financial instability for citizens. As sovereign debt burdens become increasingly unmanageable, confidence in traditional fiat currencies naturally begins to erode. Investors recognize that governments may ultimately rely on inflation to reduce the real value of obligations. This debasement trade drives capital away from paper assets and directly into physical stores of value like gold. The transition toward a multipolar monetary system provides another structural pillar supporting the long-term rally. Many nations are actively seeking to reduce their heavy reliance on the United States dollar globally. This strategic shift responds to geopolitical fragmentation and the frequent weaponization of global financial networks recently observed everywhere. Emerging market central banks have accelerated their diversification strategies by aggressively accumulating physical precious metals reserves. These official sector purchases have demonstrated remarkable price inelasticity over the past several consecutive quarters recently. Central banks continue buying even at record high prices to ensure their monetary sovereignty and independence from others. The People's Bank of China reported 16 consecutive months of steady additions to its official reserves. Their massive accumulation program pushed total holdings to an impressive all-time high during the spring. This relentless buying activity established a formidable floor underneath the global market, preventing severe price declines from occurring. China is not alone in this strategic endeavor to bolster national reserves with tangible physical assets. Other nations, including Poland and Brazil and Uzbekistan, have also reported significant and consistent monthly purchases. This widespread sovereign demand underscores the enduring utility of precious metals in a geopolitically fractured economy we navigate. Precious metals serve as the ultimate neutral asset because they carry no counterparty risk whatsoever currently. They operate entirely outside the jurisdiction of any single government or centralized financial clearing institution worldwide. This unique characteristic makes them incredibly attractive to nations fearing potential economic sanctions or asset freezes imposed internationally. Beyond the official sector, robust physical demand from Asian retail consumers provides additional support for prices. Chinese buyers have flocked to the market despite the elevated costs in their local currency terms. They view physical ownership as vital protection against domestic property market weakness and potential currency depreciation happening locally. Local price premiums in mainland China surged significantly following announcements of new international trade tariffs recently. These elevated premiums typically foreshadow a strong acceleration in both retail and institutional demand across Asia. Such vigorous local buying activity continually tightens the available physical supply available to Western financial markets every day. Indian consumers also contribute massively to the underlying physical consumption trends driving the global market higher. Rapid economic growth and deeply rooted cultural traditions ensure that jewelry and investment demand remains resilient. The expanding middle class allocates a significant portion of their growing wealth toward traditional tangible assets like gold. Western institutional investors are finally beginning to participate more actively in the current structural bull cycle. Exchange-traded fund holdings experienced a massive resurgence as capital flowed back into physically backed products. These accessible investment vehicles allow portfolio managers to gain immediate exposure without managing physical storage logistics or security. North American funds led the dramatic reversal in institutional sentiment after years of continuous net redemptions. The sudden influx of billions of dollars created immense procurement pressure on the underlying wholesale markets. Authorized participants must acquire actual physical bars to back the newly issued shares of these funds without delay. State Street Investment Management analysts note that the current accumulation cycle still has significant room to run. Total holdings in these financial products remain well below their previous pandemic-era peak levels currently. A return to those historical allocation weights would necessitate massive additional purchases from the financial sector entirely. The mining sector also reflects the profound impact of this new higher price regime on profitability. Senior producers are generating record levels of free cash flow as their operating margins expand dramatically. Companies with established infrastructure enjoy massive capital efficiency, advantages over expensive and complex greenfield development projects right now. However, the mining industry struggles to meaningfully increase overall global production despite the powerful price incentives. Developing a new mine requires extensive permitting processes and massive upfront capital expenditures over many years. This structural supply inelasticity ensures that sudden spikes in investment demand translate directly into price appreciation without fail. Furthermore, environmental regulations and geopolitical risks complicate the extraction process in many resource-rich developing nations. Resource nationalism threatens the profitability of international mining conglomerates as host countries demand larger revenue shares. These operational challenges severely restrict the ability of the industry to flood the market with supply very quickly. The convergence of constrained supply and accelerating multifaceted demand creates a highly explosive market environment currently. Quantitative models utilized by major investment banks struggle to accurately map these unprecedented structural transformations effectively. Traditional forecasting methodologies relied heavily on cyclical mean reversion principles that no longer apply to reality at all. Technical analysis reveals that the rapid ascent broke through numerous historical resistance levels with surprising ease. Once the price breached the $5,000 threshold, programmatic trading algorithms accelerated the upward momentum. These automated systems recognize pattern breakouts and execute massive buy orders that amplify the directional movement entirely upward. Options market positioning further contributes to the extreme volatility observed during the first quarter trading sessions. Large concentrations of call options force market makers to aggressively purchase the underlying asset to hedge. This dynamic creates a gamma squeeze that propels prices upward far faster than fundamental drivers dictate normally today. When sudden corrections occur, the unwinding of these leveraged derivatives positions exacerbates the rapid downward velocity. Margin calls force speculative traders to liquidate their holdings indiscriminately to cover escalating financial obligations immediately. The resulting flash crashes temporarily terrify retail investors, but ultimately clear out the dangerous speculative excess quite efficiently. Professional wealth managers recommend that clients maintain disciplined allocation strategies amidst this chaotic and unpredictable environment. They advise distinguishing carefully between core long-term holdings designed for wealth preservation and speculative positions. A prudent approach involves gradual accumulation during periods of severe market weakness, rather than chasing rallies blindly upwards. Physical ownership provides the ultimate protection against severe counterparty risks inherent within the modern digital economy. While financial derivatives offer convenience, they introduce vulnerabilities during systemic liquidity crises or institutional clearing failures. Tangible assets stored securely outside the financial system ensure absolute accessibility regardless of broader market conditions turning negative. The macroeconomic outlook suggests that the structural bull market logic remains incredibly solid for the future. State Street Investment Management concludes that the core thesis has not fundamentally changed despite recent volatility. Investors who successfully transcend short-term emotional reactions will likely capture enduring opportunities in this space moving ahead. A potential resolution of the Middle East conflict could temporarily alleviate some safe haven demand pressure. Such a geopolitical de-escalation would remove a portion of the risk premium currently embedded internally. However, the underlying fiscal and monetary imbalances guarantee that the primary long-term growth trajectory continues entirely uninterrupted. The Federal Reserve faces an impossible dilemma balancing inflation control against the stability of sovereign debt. Sustaining high interest rates threatens to trigger a devastating cascade of corporate defaults and bank insolvencies. Conversely, premature rate cuts risk reigniting the dormant inflationary fires that recently devastated working-class purchasing power totally. This agonizing policy predicament ultimately favors hard assets over traditional paper investments like equities and bonds. Precious metals historically thrive during periods when central banks lose their credibility and policy flexibility simultaneously. The current environment perfectly mirrors these historical precedents, setting the stage for substantial wealth preservation operations moving forward. Industrial applications for precious metals also provide a steady baseline of consumption that supports overall prices. The rapid expansion of renewable energy infrastructure requires massive quantities of conductive materials for efficient transmission. This technological transition creates an entirely new demand vector, completely separate from traditional monetary or jewelry market sectors. The interconnected nature of the global economy ensures that local disruptions quickly cascade into worldwide consequences. The weaponization of trade policies and the implementation of aggressive protective tariffs dismantle decades of globalization. These protectionist measures inherently drive consumer prices higher and reinforce the persistent structural inflation narrative dominating conversations everywhere. United States domestic political uncertainty further complicates the economic forecast as deeply polarized factions debate priorities. The looming threat of government shutdowns and bitter legislative battles over the national debt terrify investors. Capital flight away from sovereign bonds accelerates when basic governance mechanisms appear fundamentally broken and dysfunctional to observers. State Street Investment Management accurately identifies these multifaceted challenges in their comprehensive monthly market monitor publication. Their research emphasizes the vital importance of distinguishing between temporary cyclical pressures and permanent paradigm shifts. The firm maintains its 50% probability base case for continued significant price appreciation throughout tomorrow and beyond. Market participants must remain vigilant and continuously reassess their portfolios as new economic data becomes available. The interplay between rising energy costs and slowing corporate earnings growth creates a perilous landscape today. Diversification into alternative assets represents a prudent strategy for mitigating the escalating risks of wealth destruction globally nowadays. Investors watch $5,000 gold transitioning from a shocking milestone into a stable baseline eventually. The psychological resistance associated with massive round numbers inevitably fades as markets adapt to new realities. What once seemed impossible soon becomes the accepted standard as fiat currencies continue their downward trajectory consistently downward. The era of the great monetary rebasing has officially commenced, according to leading financial industry experts. This profound transformation requires investors to discard obsolete valuation models and embrace entirely new assessment frameworks. Success depends upon recognizing the supremacy of tangible assets in a world awash with paper promises and debt. The resilience of precious metals during the recent interest rate shocks proved their enduring relevance globally. Analysts marveled at the underlying strength that prevented a total collapse when fundamental headwinds appeared hostile. This impressive performance validated the thesis that powerful new buyers have permanently entered the global marketplace for good. Looking ahead, the trajectory remains heavily dependent upon the evolution of the Middle East conflict, specifically. A broader regional war would shatter global energy markets and instigate a massive flight to safety. Conversely, a negotiated peace settlement would facilitate a healthier and more sustainable period of market consolidation moving forward. Regardless of the immediate geopolitical outcomes, the fundamental arithmetic of sovereign debt guarantees ongoing currency debasement. Governments possess no politically viable mechanism to honestly repay their astronomical obligations without resorting to inflation. This mathematical certainty provides the ultimate long-term foundation for the State Street Investment Management forecasts published recently. The journey above $5,000 per ounce signifies a historic milestone in global financial history. Despite terrifying short-term volatility and numerous economic headwinds, the primary structural bull market remains unbroken. Astute investors recognize that these periods of extreme turbulence often create the most lucrative wealth opportunities ultimately available.